FY26 earnings conference call and webcast. At this time, all participants are in listen-only mode. A question-and-answer session will follow the formal presentation. You may be placed into question queue at any time by pressing star 1 on your telephone keypad. As a reminder, this conference is being recorded. If anyone should require operator assistance, please press star 0. It's now my pleasure to turn the call over to Vice President, Marketing and Communications, Teal Hoyos. Please go ahead, Teal.
Thank you. Welcome to the 2026 second quarter earnings call. This call will include forward-looking statements. These forward-looking statements contain projections of future results of operations or of our financial position or other forward-looking information. We intend these forward-looking statements to be covered by the safe harbor provisions for forward-looking statements contained in Section 27A of the Securities Act of 1933 and Section 21E of the Securities Exchange Act of 1934. We believe that it is important to communicate our future expectations to investors. However, investors are cautioned not to unduly rely on forward-looking statements, and such statements should not be read or understood as a guarantee of future performance or results. Such statements are subject to risks and uncertainties that could cause actual results or performance to differ materially from those discussed as a result of various factors, including but not limited to risk and uncertainties discussed under Item 1A Risk Factors in our annual report on Form 10-K for the fiscal year ending December 31st, 2025, or quarterly reports on Form 10-Q for the quarter ending March 31st, 2026, as well as other reports we file from time to time with the SEC. These forward-looking statements speak only of the day that the statements are made, and we do not undertake or intend to update any forward-looking statements after this call or as a result of new information. At this point, I would like to turn the call over to Plug's CEO, Jose Luis Crespo.
Good afternoon, everyone, and thank you for joining our second earnings. Has real conviction about the rest of the year. We are executing, our numbers are moving in the right direction across the board, and today we're raising our full-year revenue growth guidance as a result. Paul will walk through the financial details in a moment, but let me start with why we are excited. Approximately break-even, it was about negative 0.9%, compared to a negative 30.7% a year ago and a negative 13% just last quarter. That's a meaningful step in a single quarter, and it's the direct result of the operational discipline we have built into Quantum Leap, which is our restructuring program, combined with improving service margins and better plant utilization in hydrogen production. Quarter is squarely within reach. Operating expenses declined approximately 50% year over year to $62 million. Again, a direct reflection of the discipline we have driven through Quantum Leap and our continued asset monetization efforts. And on the cash side, net cash usage improved to $61 million this quarter, a reduction in cash usage of about 50% towards profitability. Our priorities for 2026 are clear, and they haven't changed. Disciplined execution, profitable growth, and continued improvement in cash utilization and operating leverage. What has changed is our confidence in how the year plays out. On our last call, we guided full-year revenue growth of 13 to 15%, based on our first year. Our business has historically been second-half weighted, with the fourth quarter benefiting from year-end deployment cycles. And everything we are seeing tells us that pattern is expected to hold again this year, with even more strength behind it. Material handling continues to be a genuine bright spot. The growth story here just keeps on building. Service revenue grew 82% year over year to $29.8 million, with service margin of 27%. As improving reliability lets our technicians cover more units and drive real overhead leverage. more than 20,000 GenDrive units over the next 3 years. This is a multi-year revenue opportunity sitting right in front of us, and is exactly the kind of... We announced the FID of the 30 megawatt Barrow Green hydrogen project for Carlton Power in the UK. This is part of the 55 megawatts we were awarded in November of 2025, and we expect the additional 25 megawatts to reach FID in 2026. In Q2, we were also selected for the 275 megawatt FEED on the H2Gen current project in Quebec. And on July 7th, we announced Hub in Australia, and this is the largest renewable hydrogen project to reach FID in Australia. As an update on the business, our 100 megawatt project with Galt in Portugal and our 25 megawatt project with Iberdrola and BP in Spain continue progressing positively on the commissioning. But I also want to flag something bigger on the horizon here, because I think it is called RED III into a national law across EU member states. Spain is the latest country to release a draft framework establishing a 11% renewable fuels on non-biological origin, which is the RFNBOs, 2030. In addition, the European Commission approved a 780 million euro Dutch subsidy scheme targeting 400 mega auction in December of 2026 with a budget of up to 500 million euros. Now, this is the kind of regulatory tailwind that turns a strong pipeline into a durable, multi-year growth runway, and we like our position to capture it. Now, turning to hydrogen, from negative 91% a year ago, on improvement plant utilization, production efficiency, and network optimization across our, and we expect that progress to continue through the second half of the year. We ended the period with 161.9 million of unrestricted cash, with net cash usage improving to 61 million for the quarter, down approximately 58/13, where we indicated approximately 80 million of expected near-term liquidity. We have already received 47 million. This is a step forward on this initiative in the coming quarters. So, put simply, this was a good quarter, and it sets up an even better second half. And we are raising our full year guidance to 15 to 16% growth. We remain on track to deliver positive EBITDA in the fourth quarter, a view of the quarter, including our liquidity position and financial outlook. Thank you. Paul?
Thank you, Jose Luis, and good afternoon, everyone. It is compounding. We exited Q2 at essentially break-even gross margin, roughly a 30-point improvement from a year ago. Second, our cost discipline is showing up everywhere it should, including improved margins and reduced OPEX, which yields reduced cash use. And third, revenue for the quarter was approximately 178 million, which was up 9% sequentially, bringing the first half to 342 million, up 11% year over year. The first half is slightly ahead of the range we outlined in May, so the shape of the year is playing out slightly better than the way we told you it would. We expect some growth in Q3 26 sequentially and over the Q3 of prior year, but the majority of the volume in the second half forecast we expect unfolding in the fourth quarter of 26. On margins, let me expand a bit because this is where the last 2 years of work, recognizing benefits based on the tariff recoveries and reduced tariff spend. Service margin was 27% positive as unit reliability keeps improving. Our cost of service is down materially, and that's letting us expand the tech unit coverage and drive overhead leverage. PPA loss rates improved to roughly buyback program, which reduces our equipment lease cost. Fuel margin improved to roughly negative 48% from negative 91%, as Jose, but these are structural improvements, not one quarter effects, and they keep lowering our break-even threshold. Just to prelude the second half in context of our target to achieve positive EBITDA in Q4, this will come mainly from increased gross margin and will stem from many factors. driving more sales as the second half will be 40% higher than the first half, and this will mostly come from equipment volume. Drive service reliability improvement trends and driving enhanced tech leverage, especially given the number of sites and gen drives being deployed in the second half. Further improving the fuel network leverage given continued growth in fuel sales and focus on network logistics costs and network efficiency. And driving even more improvements in our PPs, principally the $37 million gain from a resolution of a customer contract dispute we settled in June. Excluding that recovery, and operating expenses continued to decrease, and we believe we remain on the path towards the roughly $75 million a quarter run rate we discussed in May. The OPEX reduction stems from continued scrutiny over headcount, discretionary spend discipline, and from reduced CapEx spend yielding lower depreciation, price appreciation in the quarter. Adjusted EPS was a loss of 7 cents versus 18 cents a year ago, and reconciliations on these adjusted EPS numbers are in our tables. The net cash usage for the quarter was roughly $61 million, an improvement of 58% over Q1 of 26. The continued asset monetization efforts is contributing to margins and overall reduced cash usage, but even setting those aside, on about $28 million from year end, and we still expect at least $100 million of inventory reduction for the full year, weighted to the second half. Capital spending means we have over $670 million in total cash. The restricted cash continues to keep coming back to us, more than $115 million released in the first half, and roughly $155 million of the remaining balance is scheduled to release over the next 12 months. It is effectively a built-in non-dilutive funding stream and separate gateway. The first phase is these program to unlock more than $275 million through this overall asset monetization non-dilutive financing program. Out of this initial $80 million in July and August to date, we've received already $47 million, bringing the total for this endeavor so far to $52 million. For the full year, we plan for our sales growth of 15 to 16%, and we believe that the first half puts us squarely on that year and the ones that I've outlined today. We believe we have the balance sheet and clear non-dilutive capital opportunities to execute. In summary, we believe over to Jose Luis.
Thank you, Paul. So now, again, thank you for attending the call, and we'll go to the questions part of the call.
Thank you. Now be conducting a question and answer session. If you'd like to be placed into the question queue, please press star one on your telephone. Please ask one question and one follow-up, then return to the queue. Our first question today is coming from Colin Rusch from Oppenheimer. Your line is now live.
Thanks so much, guys. Appreciate the question here. Can you talk about the drivers for the service margins? How much of that is being driven by the improvement?
It's improving, and that's leading to us being able to use less techs to actually service the units, cautiously increasing pricing on services to be aligned to the reality of the cost of servicing the unit. So all of that together is sustainable.
Excellent. And then, just thinking about, the pipeline of hydrogen projects, you guys have made a nice dent in moving these things forward. I'm curious about urgency around some of these projects in Europe, starting construction and really starting to see.
Europe, Orica, for example, I think it got lost a little bit in the market dynamics, but Orica is a 50 megawatt order, first FID project in Australia. And you think about it, our largest order was 100 megawatts from Gulf. We see even our own projects that we have in Spain with our joint venture with Acciona moving towards FID with subsidies being awarded by the European Hydrogen Bank. I think those two projects have the largest per kilogram award in the market. So we see a lot of activity in the European market. We see many projects that are coming along to get to FID by the end of the year, beginning of...
Eric Stein from Craig-Hallum, your line is now live.
Hi, Jose Luis. Hi, Paul.
Hi, Eric.
Hey, Eric.
Hey, so I was hoping we could talk about material handling. Interested in these two customers, the 20,000 units over 3 years. As I think about how you've talked about talking about these two customers, I'm curious. I mean, is it fair to say that this is kind of sped up a little bit versus previous expectations, or is this more kind of the normal refresh, versus they're just proactively deciding to do it for the next gen fuel cell?
We are expecting to start refreshing with the two largest customers in the next 3 years to complete the total fleet. And as the units are becoming more reliable, and as we are basically coming with all the upgrades and all the improvements that we've done to the units in the field, the new units are going to have that already in the production units. The customers are also interested in doing the refreshes, but mainly they are driven by the normal natural timing of the refreshes, which is starting now.
Their footprint, or it would seem like this could be a multi-year beyond the 3 that you were talking about for this specific opportunity with these two.
This would be their normal footprint for renewals or refreshes of the units that they have in the field right now. I'm not sure, maybe if I didn't understand the question correctly, please.
Well, I just would add that there's, if you think about it like a portfolio, there's more and more sites that is hitting a major refresh cycle starting here now, and the other one, although they've been on refresh, it's starting to grow and build just because of those dynamics.
So I guess it's going to be refreshes on top of the normal growth on those customers.
Thank you. Our next question is coming from Chris Dendrinos from RBC Capital Markets. Your line is now live.
Yeah, good afternoon.
Thank you, Sharif. We're going to continue operating more efficiently the plants. We have the 3 plants, Tennessee, Georgia, and Louisiana plants. On the logistics side, we're going to continue also improving our logistics. We are continuously trying to make sure that we effective way that's possible. And finally, we are working in each one of the sites and also in the plants to make sure that the actual efficiency of the systems.
Got it. Thanks. And maybe just as a follow-up to an earlier question on the electrolyzer pipeline here, and you had highlighted Spain being a potential of when demand would potentially pick up for that market specifically. Thanks.
So drivers for each one of the countries before 2030. So what we're going to see, and 2030 is here. I mean, we are right now mid of 2026. So we have basically Iberdrola and BP and the project with Galp, and some of the projects that we have, smaller projects on the refinery side, is a result of these months, and it becomes an actual law. We are expecting that companies start actually executing and moving forward with the projects. We have many of those projects are already in our funnel. This is the $8 billion funnel that we've been talking about. These are not new projects that we're going to basically pick up right now. It's projects that have been
coming from Samaya Jain from UBS. Your line is now live.
Hi, team. Congrats on the quarter. So now that gross margins have approached break-even territory in the second half of the year.
I'm going to let Paul take that one.
Yeah, I think so. The first thing is sales volume. If you think about us, with the numbers that we've shared in the forecast of our guidance, as I said earlier, that suggests. The second is we still got lots of opportunities on the manufacturing cost, and so we're still very early in the electrolyzer equipment and continue to plan further cost downs on that as an example. The other 2 big buckets really is more units per tech as we continue to scale, and since we have a lot of units and sites going live in the second half, we're continuing. A few minutes ago, it's about the fuel, and so as we continue to scale volume on our fuel network, drive out improve logistics costs and efficiencies of the systems, those are the themes that you're going to continue to see collectively drive margin. But in the second half in particular, it's mainly sales volume. It's just such a big.
With recent milestones like the order for Orica and the Carlton Power FID, what is the conversion rate timeline for turning feed scopes such
as we mentioned, and the estimated FID timeline is beginning of 2027. It could, with these big projects as well that are going into the same process, and we're seeing projects converting into FID, like as you mentioned, the Orica 50 megawatts and the.
I just wanted to check on the cash management strategy in terms of the balance sheet load, the interest rate load. Is there and also money coming in from these asset monetization efforts. Is there any effort to reduce the debt?
The convertibles, and they're termed out in 8 years from now. There's no amortization of that. It's relatively speaking a low cost interest unsecured facility. So progress that we're making and in terms of improving yield, growing sales, growing the margins, improving cash flows. We certainly expect in the second half as we pour debt and capital solutions at lower cost options. But we're in a good position right now. We ended the quarter with a pretty sizable visibility of another $30 million to $35 million in the short term as that effort continues. And so we're in a good position as we sit now that to kind of fund the balance of the year.
Understood. Thanks for that. And then just one stepping back, your outlook for this growth is mostly going to come from equipment sales. What kind of visibility do you have? Are there any takes and puts that may exceed your guidance or?
We feel we have good visibility and expecting to meet that guidance. The majority of the second half of the year.
Today is coming from Craig Irwin from Roth Capital Partners. Your line is now live.
Good evening, Jose Luis and Paul. Thanks for taking my question. First, systems in your factory being prepped for delivery for very big technology names, Fortune 50 type names, kings of the data center market. What do you see as a potential avenue, or are you exploring the opportunity for data center participation for Plug? If you had a couple $100 million in incremental capital, is this something that you would?
Well, Craig, thank you so much for your question and for attending the call as usual. I appreciate the big picture question, and it's a good hypothetical. If we had $200 million of capital to deploy. Obviously, the data center market is a market with a 3 megawatt system with Microsoft for backup power for data centers. Right now, as Plug, as we have said, be bringing a lot of the growth in the company. The other one is electrolyzers. As I went through it before, the European market is about to get in, and it is an enabler for our business. Without hydrogen, none of these things really run. So those are the areas of the business that we are concentrating. Definitely, it's something that we're looking into. It's something that, we haven't made any decisions. And right now, at this moment, we're concentrating.
I like that. Thank you. So my second question is positive EBITDA in the fourth quarter. That's obviously, something if maybe we continue along this positive trajectory, mid to upper teen revenue growth, continued structural improvements in gross margin,
that we reinstate those, which is what we have given right now as guidance. And at this moment, we're not giving any additional guidance.
That growth trajectory. So, achieving it in Q4 is going to be a big milestone, but it also postures us as we continue, and we expect to grow about the prospects. And I'm sure as we move forward through this year, we'll be in a position to talk more and more about 27 and onward, but we're postured really well.
Project that FID'd and a 50 megawatt project that FID'd. Can you shed a little bit of light on the timeline for these bigger projects after FID? How long before?
Just these two examples on the project in the UK. We have already started delivered, depending on the project, obviously, I'm just going to give you high-level timelines. 12 to 15 months to start installation. In some cases, it's a little bit manufacturing. Our projects that we structure with milestone payments, and we also structure with percentage of completion account.
Got it. And then maybe something a little different. Last week, the governor of Texas announced a moratorium, the counterparty for that transaction.
That last week, our understanding is were outlined in the letter, just to make sure that the projects are, the right projects and that they are real projects and not projects that are streamed through that process. And we continue with the efforts that we have discussed about the monetization of the assets in Texas and New York. So and obviously, going through whatever the government in Texas requires that we need to do.
Okay, super.
Hi guys, just a couple on the electrolyzer business from me. Firstly, just thinking back to your symposium last year, I think your partner before the end of the year. So just wondering if you could provide an update on those mega projects. And then second one on the electrolyzer business, you mentioned XR, and then importantly, kind of what the funding plans would be for those projects once they took FID. That would be great.
The progression of the projects in Australia and in Uzbekistan, we announced both projects. And as I was saying before, these type of projects are complex and they take in either project. It seems like Uzbekistan is moving a little bit faster. But we keep on working on helping to try to get those projects with them. But the most advanced projects are a project in the region of Navarra, in a city called Sangüesa, 27. And we will work with Acciona to find the funding for the projects. The same thing goes with the project in Zaragoza, which is the one that just got from the European Hydrogen Bank. In the case of Zaragoza, that project is a little bit less developed than the project in Navarra, while in the case of Sangüesa, we already have lined up a potential high probability of taker. So that's the situation with those two projects.
That happened between the two calls, but I believe Paul said that progress towards Q4 EBITDA profitability is going to primarily be driven by continued gross margin improvement.
Via a contract dispute where we had previously taken a reserve against that position, and because we got a large nominal restructuring and other charges in that bucket. But if you back that out, 75 million is kind of our expected run rate. So to the EBITDA target, it's mainly through gross margin in the back half of the year. So in Q4, so both off the first half, and most of that is through equipment sales. So it's it becomes very accretive when you sell incremental equipment when you've already covered your fixed cost in Q2.
Very helpful. Thank you very much.
Thank you.
Thank you. We've reached the end of our question and answer session. I'd like to turn
this quarter gives us a strong foundation for the second half. Margins are improving, cost discipline is holding, our backlog is growing, and well beyond it. Thank you again for your support. We look forward to updating you on the process in the next quarter.